Okay, so this is a typical. I guess I plotted on the y-axis the NPV, and on the x-axis is a timeline, and this is just a schematic of a coal project life cycle. In the early stages, the NPV is negative because you're trying to discover the resource. You have to do a lot of drilling. You probably have to do some seismic. You have to get permits. You're actually spending more money than you're actually making or what the asset's worth because you're not really sure of the valuation. As you get into a commercial discovery or start getting some kind of independent reserve or resource certification, then the value of your project goes up quite a lot. So you're increasing your NPV. Moving on from those, and this all costs money. Moving on, if you manage to secure some kind of off-take agreement or some strategic partnership, I think your NPV goes up further. And as I said earlier, the whole thing about conversion of resources into cash flow, that's probably when you start production, and that's when production means revenues and hopefully profits. So that's probably your peak NPV. And anyway, typical styles of different ways to value coal companies. I think the most accurate is the DCF methodology, which requires you have to do a financial model, something like I've shown there on the right, which has all the parameters. Usually engage some kind of independent technical consultant to come up with all these, and usual garbage in, garbage out. But if you've got a good handle of this, you can work out a good NPV. You need things like production levels, yields, mining costs, transport costs, that take a view of the coal types and their prices to do that. Another sort of way to value is your in-ground resources or reserves, and it's usually on an enterprise value, which is like a market cap number, dollar number over tons of your measured and indicated resources. The risk with that is you've got to make sure you're comparing apples with apples. And then there's a quick back of the envelope assessment. I mentioned it's all about making profit. So the price minus cost times production gives you a proxy for gross profit.
Let's talk a little bit about the demand side, because as you were saying before, there is an incredible amount of demand from some of these growing economies. India is competing with the United States to be the second largest coal consumer, obviously China being in #1 position. But at the same time, even though India has very large coal reserves, they're also, with apologies to our Indian members of the audience, they're also extremely bad at mining coal, are they not? You might come across statistics which show that for every employee in the coal mining industry in India, they generate about 1,100 tons of coal. One employee, 1,100 tons. In China, that statistic or that ratio is at about 12,000 tons per employee. And Peabody, the largest developed market coal producer, for every employee, they produce 36,000 tons. So do you see this turning around anytime soon, that perhaps government regulation or perhaps productivity and technology increases will help India not only consume a lot of coal, but actually produce a little bit more as well?
The Indian market and the producers have gone a long way in the last few years to try to make that efficient. There are a lot of very experienced groups, coal groups in India that are now made some massive investments offshore, like Adani and Tata, GVK. So these guys are learning like everyone. I mean, coal is very specific. One coal field in Australia could be extremely different to a coal field in Indonesia or a coal field in India. So it's not one size fits all. So I guess that's what I can say. But I think the Indians realise that they have got a big issue in terms of an amazing amount of demand going forward that they need for coal, that they are actually, necessity is the mother of invention. They are actually working well towards achieving certain targets, but they're also aggressively going out and increasing their supply links, or where they can buy coal and signing up contracts and investing overseas as well.
Hi, this is Shekhar from RHB Investment Bank. At the start of your presentation, you mentioned that the theme for 2015-16 is going to be conversion. So you need to focus at companies who are going to convert their resources, which have been mined at cheapened cost, to cash flows. Now, if you look at the kind of companies that I've been seeing, because I've been a mining analyst for 9 years now, the kind of companies I've been meeting lately are those with no plans to come into production anytime soon, but they're aggressively looking to raise capital. Now, in this kind of environment, in a low coal price environment with no visibility on prices moving up, how do you value these companies, or how do you what suggestions would you give to investors when you look at these RTOs coming into SGX?
That's a good question. And you've been around for 9 years, which is good because I'm going to go back to that point. 9 years ago, when you had a company that had just the molecules in the ground, and you went up to a banker like yourself or like myself and said, "Hey, I've just got, here's my JORC reserve report. What can you do?" And this is in the heydays when pre-Lehman's, when money was awash and everyone was going crazy, right? The silly season, as I called it. I mean, what do you do with that JORC reserve report? And you know what I'd say? You could do anything with it. This was your ticket to riches. This was like you had something in the ground that no one else had, and there was that talk about now we got oversupply. That was severe undersupply. So I could sell this piece of paper, this reserve report with the reserves in the ground for such a high premium. And then you'd go to a bank and say, "Can you finance this?" And they said yes. And then you say, "We want to IPO this," and you get crazy multiples. And we want to divest this or sell this or run an M&A process. It was amazing. It was a good time to be a banker, and a good time to be an owner of an asset. So your comment on valuation is back then there was massive premium on valuations like that. Now, if you go up to the banker like yourself and say, "Hey, I've got a reserve report," the banker's going to say, "So what? Come back when you have, remember all those risks I mentioned? When you've got a proper management team, when you've got a pathway to cash flow, when you've got logistics sorted out, and then the banker will take a view on how far you are from production." Back to my conversion to cash flow. I can point to a lot of great coal projects around the region that have got massive reserves, but are like 5-10 years away from production, and $5 billion away from production because of capex investors. And those guys are really suffering. Those kind of guys are companies that have got large reserves, large resources, but you can't get it into cash flow yet. So, in those times, an equivalent company could be worth $2-3 billion, and now you'd be lucky to get $100 million for that same asset. That's how the differential has been, I think, over the last 10 years. So I get a lot of guys who say, my asset was worth $2 billion and someone offered me that in 2008, and now they still want that same price. And I'm saying, you'd be lucky to get 200 million for it if it's like 5-10 years away from production. So how do you value that? You value it as a great discount. If someone's got, I still think, and this is probably the fundamental geology part in myself, if you've got a good quality asset, hold on to it and try to ride the cycle. But if you really have to sell it now, you'll definitely sell it for a massive discount, which means now's a good time to buy. If you're an M&A guy and you're cashed up, now's the time to approach the guy who hasn't got money and try to get this asset for that discounted valuation.
So if you own a coal mine and you're a chief executive who's got a JORC report, better play golf with somebody rich who still thinks that it's worth something. Brian, more questions.
Okay, a follow-up question here. We're pretty much clear that it's an oversupply market right now. There's a lot of coal coming out of Australia, Indonesia. So the key concerns here are obviously on the demand side. Now, if you look at last year's full year numbers, China's imports are down 15% year on year, and India hasn't really caught up in terms of import growth. Now, when you look at companies, and effectively if you're doing a DCF valuation, you have to build a view on coal prices, and that would effectively be determined on how much longer can China hold its import demand and how fast India can ramp up. I would like to get a sense from the panel, what are your views on likely outlook for China's import demand growth and India's import demand growth?
How much coal does China produce per year? 6 billion? How many? 4 billion, yeah. Oh yeah, 4 billion. So China produces 4 billion tons of coal per annum. And it's got most of China's coal sits on the western side of China in the western basins, and they have to transport this coal from the western basins right across to the east coast, where all the people are and all the industries, Beijing, Shanghai, Shenzhen. So there's a massive, massive transport logistical process going on within China, trying to get this coal 5,000 kilometers away in these basins into where the demand centers are. And, they need they're producing 4 billion tons of coal, and they probably need 4 billion tons of coal. Let's call it a parity, right? Supply equals demand. If something went wrong in China, where there was a flood or a strike or environmental issues, or I think more likely perhaps some transport type logistical problems, and the coal production or supply went down 2%. What's that? 2% of 4 billion is 80 million tons. This shows you how sensitive China is to an import or export scenario. So if something went wrong, which happens all the time, not just China, but that's life, with any of those production network of taking all this coal from the west coast to the east coast, and production dropped 2%, which is nothing, right? That's rounding error. It's not rounding error. That's 80 million tons. That's the size of probably 2 Bumi resources, which are the largest coal exporters in the world, Indonesia. And that's where you need to catch up. So let's say something happened in China and you need 80 million tons. Where are you going to get that? And that will definitely create a spike in the coal price, I'd say.
Well, maybe the folks in India will pick up production and can start to supply. Do you have a view on India too? You answered the China question so knowledgeably, I thought that maybe the India question would be a piece of cake.
Okay, West Coast India, right? Now, I think India's got a lot of coal reserves, and as we said, there's a lot of inefficiencies that have plagued the industry over the last decade or so, but I do believe they are getting their act together, so that will increase production. But when you look at, and you're an analyst, when you look at every single demand forecast for India, the numbers are staggering. I mean, the amount of energy that India is forecast to need over the next 10, 20 years is like, there's just not enough. So even if all these analysts got it wrong by 90%, there's still a large demand issue.